Hey everyone, welcome. Good to see you guys. Hey John, good to see you. Uh, so look at this market. What can you say? It was very bullish. Hey Kevin, great to see you too. So bullish. Yesterday we talked about how we likely wouldn't have government shutdown. Was wrong about that. Obviously, we got the government shutdown, but even if we got the government shutdown, we didn't think it would affect the markets. The markets just really wouldn't care about it, and that's exactly what we got. You see, we opened basically at the low. The low was 663.06, and the open was 663.17. So it didn't really go very much lower than the open. Our EMA 8 was at 663.81. So, or at least it's currently at 663.81. It wasn't that when we first started the day. So let's take a look at that and see that when we started the day, it was different, right? It was lower than where it is right now. So intraday, we never really even touched that EMA 8. We came close to it. And so basically we bounced off of that EMA 8. We gapped down to the EMA 8 and then we traded up ever since that. Very bullish. And we closed above the previous high and we opened above or our low is above the previous low. That's very bullish. So what we were saying yesterday about, hey, even if there is a government shutdown, it won't really matter. The market isn't really going to care about that. That turned out to be very true. Now, now that we bounced up here, well, we are at all-time highs. We created a new all-time high today. So the high was at 669.37. That's really aggressive, but even the close is at an all-time high as well at 668.45. So the previous all-time high was over here, I believe on the 23rd. And so now we're at brand new all-time high despite the government shutdown. Now this is a little aggressive. It's a little too much too fast. So I won't be surprised if we consolidate a little bit right here. I wouldn't really say pull back because where are you going to pull back to? That EMA 8 really isn't that far away. And if it does come back and touch the EMA 8, do I really call that a pullback when the last 1, 2, 3, 4 bars have touched the EMA 8 on their low? That EMA 8 is going higher, the highs are going higher, the closes are going higher. So that would just be a very steady movement upwards. So I'm not expecting this to go screaming higher over the next few days. Just a nice steady move maybe, or a pause. If we look at this on a weekly chart, what we see is that the S&P 500, it really doesn't move more than 2% per week all that often. And we can just look at these, the exception, sorry. The exception is after a strong pullback. If there's a strong pullback, then yeah, it can move quite a bit. So this was a strong pullback. When it's bouncing back, that's 5.69%, 67%. And here it was down a little bit. Here it was back up 4%, and then here 2.93%. And after that, this one a gap up 5.29% again. But then once we're done recovering from that fast dip, then what we see here is 1.78, 1.65, negative. Here a little bit bigger, 3.47, 1.7, negative 0.64, 1.52, negative 2.49, 1.2, and you get the idea. Most of them are under 2%, 3% at the most, 2.5%, 3% at the most on a week-to-week basis. So after this, so far we're up 1% off of last week, and that's kind of a normal amount. 2% would be on the edge of kind of abnormal. And so 2% would be another 6.5 above where we closed today. And that would be 674, 675, just call it 675. That would be the most we would expect normally on the S&P 500 movement. Now, I don't think all the drama of the government shutdown is over. So I'm not just saying, hey, this is done, we're just going to move up here. I think there is going to be a little bit of drama and a little bit of worry, especially if this drags out for several days, if it's not resolved within a week. then the markets will start to worry about longer term impacts. And also, if we really don't get any data, like if we don't get the non-farm payrolls or the employment situation on Friday, then that can, the longer we go without official data, the more volatility that's going to create in the markets, because no one knows what the data is, the latest data is. And so everyone's just sort of guessing, and that creates a uncertain environment. And that uncertainty shows up in the form of volatility. So everything will just depend on how long it takes for the government to get back up and running. Let's see. Hey, Marlon, great to see you. Lise, Chris, Marlon says, awesome profit taking day. Yeah, yes, it was. You're very welcome. You're very welcome for the Tesla trade. Yep. Hey, Tim. Hey, Cosmic Spiral. Do you think Tesla pushed the SPY up? Not by itself. Definitely, it was broad market. If you look at RSP went up quite a bit also. Okay, so it was broad. It was broad general, wasn't necessarily one stock or one sector. We can take a look at the sectors in just a moment to see how they all did, but it was pretty broad. Banks selling off below the support levels that served as entries during the last 5 months is a little disconcerting. Let's bank KB bank ETF. I was going to do the small regional bank one, but I need a larger bank. KRE? Yeah, that was KBE. I was getting it right. Okay, KBE. Okay, so far, if it holds that MA50, it'll be fine. And that quarter to I thought I changed my quarter to date VWAPs already. What was it? It's 918. Okay. Yeah, as long as we hold that MA50, it'll be okay, I think. KRE, same boat. KBE, yeah, they look the exact same. Yeah. So I wouldn't be worried just yet. What did Citibank do? JPM, Wells Fargo, B of A. Wells Fargo really took a hit. B of A. What is BOA? BOA? No, anyone know Bank of America's? BAC. There we go. Morgan Stanley. Okay, yeah, a good number of breaking down, or below their EMA 20, and that overall ETF was just below its MA 50. If we can get a bounce, they'll be okay. But they're probably taking hit because bonds are mostly flat. Interest rate. Basically, do we expect interest rate cuts to happen? So we can take a look at that real fast if we look at the Fed Watch. And now that's really interesting because we're basically 100% pricing in a rate cut in October. That's crazy. And how about December? 86% pricing 2 rate cuts. Wow, that's really high. That's the highest we've seen so far. So it's looking like markets are kind of bullish, expecting rate cuts. So that employment report, we didn't get a great JOLTS report today. And so the expectations of rate cuts are now very, very strongly that we're going to get 2 rate cuts before the end of the year. Okay, rate cuts are not good not great for bank profits, right? Because they make money off of interest rates that they charge on loans for the most part. So that's probably why they're taking a little bit of hit right now. I don't think that's going to be long term though, because once everything's priced into the market, lower interest rates, then it's priced into the market. It looks like we pretty much did that today with the Fed watch moving so much. So if we look over here, just 1 day ago, so it went 3% from there, but 1 week ago, it went almost 10%. And then 1 month ago, it's been 50% higher. So, and then if we look at December, that 86 just a day ago was 10% lower, which is huge. And then a week ago was 4. So the big move was in this December. And so if that's already priced in, then I don't think banks will have a lot further to go. Hey, Vladimir. Hey, Peter, Dan. Thank you. Thank you, guys. BAC. Thank you, guys. Hey, James. Good to see you. Okay. So what I'm expecting is a little bit of a pause. It's a little over exuberant. We're not quite at the point where I say, okay, we're kind of overextended and we really should expect a pullback. We're just a little bit above where we were over here. And of course, the EMA 8 is now higher than it was over here also. So that distance between where we closed and where the EMA 8 is actually smaller than this distance right here. And so we're not super overextended, but I just don't think we have another move like this tomorrow. I could definitely be wrong. Maybe there's something to be super enthusiastic about. But like I said, so maybe if they say, oh, we made a decision, we're not shut down anymore, maybe that'll do it. But the longer we go without that decision, or longer we go with the government shutdown, the more pessimistic the market is going to become. And like I said, the less data that we get, if they really do stop releasing Fed data or Bureau of Labor and Statistics data, then the market is going to go longer and longer blind, and then that's going to create more and more uncertainty. So it really just depends on how long we stay shut down for. All right, hey Chester, good to see you. Okay, so that said, I am still very bullish on the market. I just don't think right now is the best time for entry. We would want a little bit of a pullback, or we could look at stocks that are already pulling back and bouncing. Those would be okay right now as well. So let's take a look at those sectors and see how they did. Just today only. Yep. And I don't really necessarily want to look at this because I won't be able to see everything. So let's go sectors. And this will be just for today. Okay. And so we can see that most of the sectors are up. We see this one. What is this one? This one is basic materials, financials, communications, staples, and TLT. All those took a hit. Everything else is positive and quite positive. Okay, so like especially these right here. This is the S&P right now, the candles. So at least matching it was utilities and discretionary, and then outperforming was tech, biotech, SMH, so chips, and healthcare. Interestingly, healthcare. So we definitely want to see tech and biotech leading. Healthcare is a little bit of a, that was probably Pfizer, actually. That was probably Pfizer by itself, propping up most of it. And then we do have broad-based participation though. Like anything, if we look at all the positive sectors, they outweigh the negative sectors by quite a bit. The negative sectors are not that negative, except for this one, except for materials, was way down. So overall, it's looking pretty healthy. I just don't think it's so healthy that we can expect it to run upwards. I will probably get at least a little bit of consolidation from where we are right now. Okay. So today, what I wanted to do, since it was asked of me, is most of the other questions that were asked of me are variations of how do I choose this option, or how do I know when to choose this option versus the debit spread or a butterfly or RM condor? And we've kind of gone over that already since we went over the entire trading plan. And I could go over that in more detail, but I think something that might be more useful was a later question that I received. And that was, well, now that I have these trading plans, I kind of know what goes into a trade. How do I translate that into steady profits? So the idea is that if I trade, then hopefully, ideally, otherwise we're not, there's no point in doing it. We need to get to the point where we're competent enough in our trading where we basically have an upward sloping equity curve throughout the entire year. Now, of course, it's most likely not going to look that smooth. It's going to probably look something more like this. Okay, and you're doing a pretty good job if you do that, but most people's are going to look like this. Okay. And that's not really good for predictability or sanity or being able to rely on it for growth or especially for income. So the more you need it to be income, the more you want it to be steady from left to right, okay? And this is actually what portfolio managers aim for as well, is as steady as possible, left to right. Because if you think about it, if you're a client and you have $100 million and you give it to a portfolio manager, this is what you would want to see. Some people are like, oh, well, show me compared to the S&P 500 as well. But the S&P 500 is kind of doing this also, right? It's pretty jagged. Maybe not in the last couple months, but overall it is relatively kind of like that. And it is, of course, is smoother than a small cap stock or even a single S&P 500 stock or anything else. But by the nature of its basket, it is steadier, but it's still kind of volatile. Not super volatile. It is one of the steadier products, but it is still volatile. And even bonds, if you buy treasury bonds, they're going to do this also. Although lately they've been doing this. Okay, so but the special thing, point of distinction about bonds is that if you ignore the price, so you say, I paid this much for my bonds, and that's steady. And then I just collect the coupons. So basically, every month I collect the interest rate. Then it would look exactly like this. Straight. And that's why a lot of people go, when it comes to retirement, or fund managers, when it comes to retirement accounts, pension funds, things like that, bonds are an important part of those portfolios, because by nature, if you don't sell them, or you don't look at if you don't care about the mark, like, because we don't plan on selling them, we're just there for the interest rate, then it does look very, very much straight and steady. And that's what they're looking for in their returns over the long term. And that is what allows you to be able to rely on it and say, especially if you're going to take drawdowns, if you're going to take income out of it, if you're going to draw out of it, which does happen in pension funds and it does happen in retirement funds, then you really want that smooth equity curve. What you don't want to happen is you have this, and then all of a sudden right here you have a whole bunch of drawdowns, and then it goes over here, and then you're fighting an uphill battle because you lost on your positions and you got a whole bunch of drawdowns, which forces you to liquidate even more. And then so you have a hit on the withdrawals, and you have a hit because you're forced to exit at a loss at a bottom point inside your portfolio, and then it becomes really hard to recover. So if you want to be able to steadily draw out of your account, you want as steady of an equity curve as possible, okay? What is going to determine that? Right, so that's basically what we're talking about today. So how do I go from, okay, here's a whole bunch of trading plans to, or I know exactly how to do a trading plan, to translating it into a steady equity curve, and then how big of an account do I need with that steady equity curve that allows me to withdraw on a monthly basis a certain or comfortable amount of money, okay? Does that sound like an interesting topic to you guys? Or if it's not, then I can talk about something else and then I can answer that person privately. But I figure it's probably pretty interesting to most people. So I just need to, mine has been going the wrong direction. Well, hopefully just temporarily, right? And of course it does take a while, it does take some skill, and it does take some training to be able to keep that equity curve positive. Yes, this is what I need. Okay, perfect, John. Okay, thank you guys. Okay. So I'm going to do, so the way that we approach this is going to be different for different size accounts. And the way that most people teach is they teach out of kind of textbook, what I call modern portfolio theory, okay? And I studied modern portfolio theory in my MBA program, finance programs. And we kind of talk about it a little bit as professional portfolio managers, but what comes to practicality, it's not really what we do, okay? But let me show you, and even if it was what we do, it's not what we can do as retail traders, because modern portfolio theory will really only work on really big portfolios. It doesn't really tell us, it's not very practical for small accounts or smaller accounts. Rotate chart counterclockwise for improved equity curve. That's great, Trent. That's funny. Textbooks don't work the greatest in the world. That's true. Yeah, that's true. At least in the finance world. So let's go ahead and let's take a look and at what I mean by that. Okay. Should I type? Maybe I should type. Yeah, I'll type instead of, and I'll draw if I need to. Okay. So let's just say, here's what modern portfolio theory would tell you. Just say I have $100 million. Okay. I don't want to risk more than 1% or 0.5% in any one position. So 1%, that becomes $1 million. So that means I don't want to put more than $1 million in any one position. Well, yeah, that's great. If you have $100 million, it kind of makes sense. I don't want to put $1 million into any one position, especially if I'm doing options positions, right? Because how many options would that be? If I wanted to buy, even if it was SPX options, which are pretty pricey, what's your average? If I go 1 week out on SPX, and I go at the money, it's like, call it $4,000 a contract, right? So even if I do $1 million divided by 4,000, okay, that's still 250 contracts in a single position of SPX. That's a lot. And if it was just $1,000 per contract, then you're talking about 1,000 contracts. If it's only $2.50 per contract, you're talking about 4,000 contracts just for a single position. So that, so it makes sense. What am I going to do? I'm going to buy 40,000 contracts by myself in a position. If I wanted to do 10%, it doesn't make practical sense, right? Because most, even on the SPX, you're not going to see open interest in the tens of thousands. You see that? Even on SPX one week out, I'm only seeing a few hundred. SPY, I might see 10,000s. Okay. SPY, 1,000. You see that? I'm not seeing that many. I could do it out to the monthlies. The monthlies would have more. Okay. Then I start seeing 1,000, 12,000. It might make sense. But still, do I want to be 5% or 10% of all the open interest in a single strike? And the answer is no. And so, okay, and you might scatter it across several strikes, but same thing, right? I'll still be a significant portion. And does it really make sense for me to hold a basket of different strikes in the same? It'll start becoming a management nightmare if I do that too many times. And that's on SPY, which is still a somewhat pricey option. And if I do it on something more common, like, I don't know, Target, 200, 100, then we're talking a lot of contracts, and we're talking becoming a huge significant portion. So it makes sense, even from a practical standpoint, that I wouldn't really want any one position to be more than 1% anyways. That's not too helpful if your account is, say, $10,000. Okay, because $10,000, then suddenly we're only talking about $100 allocation. And now I can't buy anything unless it's out of the money. And now I'm taking huge outsized risk by going out of the money all the time. Okay, so already just the allocation size of the portfolio management already doesn't work. Forget about the rest of it. I won't even go into the rest of it. So we already fail at the very first step. And a lot of us don't even have $10,000 accounts. What if I'm starting out with 5,000 or 2,000? Okay. Then it becomes a lot harder. So I'm going to pick, let's just call $5,000. Okay. I'm going to pick $5,000 just because I think it's a happy average. I know some people will have larger accounts. Some people will have slightly smaller accounts. But I think 5,000 is reasonable, and it can help us illustrate the point. So before, I've told you guys that as a retail trader, you don't, hi Kay, good to see you. As a retail trader, you probably don't want to be in more than 10 positions at a time. Okay? Max. And if you have a $5,000 portfolio, you're not going to get anywhere near 10 positions if you're allocating, if you're doing this properly. Okay. But let's just say it's 10. 10 positions at a time would mean 500 per position. If you allocate, and most likely, most of the time, you're not going to be 100% allocated. Okay, so $500 is reasonable. Most options, if I stay in that 40 to 70 delta, most of the options that I would want to buy are going to be $200 to $500. Okay, there might be some that are 6 or 7 or 8, and in those cases, I would say they're priced out. They're priced out of my portfolio, and I have to limit myself. So there is always an advantage. The more money you have, the more options or the more choices you have available to you, the more flexibility you have available to you. And that's just reality. That's just the way it is. Okay. But we can do very well, because especially if we start to add spreads into this. If I have a debit spread or a credit spread, just a normal vertical, I can get basically into any position for $500 or less. Because if I have a 5 wide strike, it's not going to cost me $500. It's got to cost somewhat less than that. Otherwise there's no room for my profit. Why would I go into it? It doesn't make sense, right? And then if it's 10 apart, 10 strikes apart, that thing is way too expensive anyways. There's not going to be many that either too expensive or too illiquid. So I wouldn't want to go into that anyways. So even the SPX, oops, where did I, okay, even SPX, okay, when I get nearer to the money, they're 5 apart. You see that? If I go far out, they're 10 apart, or far in the money, they're, well, even here, there's really far in the money. They're, yeah, here, 10 apart. But for the most part, if I stay reasonably within around the money, even those are 5 apart. So if I add debit spreads or credit spreads into the mix, then now everything is accessible to me. I can basically trade any ticker I want to. Okay, so we want to keep ourselves open to spreads. All tickers are available. Okay. And they help us manage risk in a small account also. So much easier to manage risk in a small portfolio if you just stick to verticals instead of single options. Okay, so what does this look like if I do 10 positions at a time? So you would never, how do I say this properly? If I'm long, then max 5 long positions. And if I'm short, max 5 short positions. So what does that look like? That means I could be long, 5 positions. And now I have half my portfolio allocated and I'm super bullish. And if there's a COVID event, then I lose half my account. But that is super bullish, right? I'm super bullish. This is going to be super rare. You're basically never going to do this. But this would be max 5 long positions. Okay. It could be just 4 long positions or 3 or 2 or 1. Or let's just say you have max 5 long positions. You could have 5 long positions and 1 short, or 2 shorts, or 3 shorts, or 4 shorts, or 5 shorts. Okay. If it's 5 and 5, then I'm neutral. If it's 5 and 4, then I'm just barely bullish. If it's 5 and 3, then I'm bullish. 5 and 2, I'm bullish. 5 and 1, I'm hyper bullish. And I would even say 5 and 2, I'm actually very bullish. 5 and 1, I'm hyper bullish. And 5 and 0, I'm just stupid, crazy bullish. Okay. We want to balance these out. Okay. And then what I'm showing you is a long short portfolio. And this is the best way for small accounts to manage their risk, in my opinion. Okay. We don't want to just take a whole bunch of longs all the time. And so if you're subscribed to 10 different alert services and they give you 10 different longs, you got to pick and choose. And you got to realize that, okay, even if I choose only 5 of them, I'm being hyper bullish. I better be really bullish about the markets. Okay. And if not, and no one's giving you any shorts and you can't pick any shorts for yourself, then you go, how bullish am I? Okay, so maybe I go, let's do it this way. Let's give you a scale. I think I should do it the other way. 5, 4, 3, 2, 1. Okay. This is the range of the possible scores if you follow my rules right here. Max 5 long, max 5 short. And this is stupid, crazy, bullish. This is neutral. This is mildly bullish. This is bullish. This is strongly bullish. This is hyper bullish. And then the opposite, okay? Mildly bearish. Bearish. Strongly bearish. Hyper bearish. And stupid, crazy, bearish. And by the descriptions, I think you should tell that you should probably live in this range right here. Okay. Oh, you're very welcome, TP and Tim. Hey, Illinois grain farmer, good to see you. So you want to live in the 3 to -3. 4 or -4 should be very rare, and 5 or -5 should just be, oh my God, COVID just hit. Okay, that should basically be it. So we want to live in this range and actually more often in the 2 to -2 range. Right now, what I would say I am in the market is I would be this, bullish. Not strongly bullish yet because we're a little hyperextended. Okay, and then so if we get to a pullback, I'll go strongly bullish. But where we are in the market right now, bullish. Okay. What if we do a smaller position? If you do a smaller position, then what you're asking me is basically you're saying, can I add more trades? Can I have more than 10 positions at a time? And my answer is going to be if you can manage it, but most people can't. So I want to be familiar with all my positions. I want to do everything I can to be super familiar with them. So that way, if anything happens in the market, I can respond very quickly. I know exactly what's going on, okay? So today, when we bounced off of that EMA8 and it went hyper bullish, I knew, okay, let me check on these few trades because they probably benefited from it. And I was surprised by a couple of them that didn't bounce nearly as much as I thought they would have. But all the rest, they did. And I was busy all morning sending out alerts, like take profit, take profit, take profit, take profit. But I knew I didn't have to go and look up and like, oh, in this program we have this one. Let's see how it reacted. And in this program we have this one. Let's see how it reacted. In this program we have this one. Okay, how many positions can you be super familiar with so that when the market moves, you know pretty much exactly what's going to happen with that position? And the answer for most people is probably not more than 10. Actually, for most people, it's probably even less than that, 5 or 6, maybe. But as a stretch, most people 10. I've had years and years and years and years and years in practice of it. So, and years and years of practice of super large portfolios. So I can do more. But most people, they're not going to be able to do it, right? Especially if they're a beginner, you really shouldn't. So get used to managing just a few, because 10 is the max. Most of the time, we're not going to have 10 positions. Most of the time, you're going to have maybe 3 or 4, maybe 5. And that becomes manageable. That's something that you can remember. You can say, oh, this morning when we wake up, if the S&P gaps up, 50 basis points, 50% or 0.5%, that is non-randomly up. And if it gaps, oh, which positions? What's that mean for my NVIDIA? What's it mean for my CenterPoint Energy? What's it mean for my lithium stock? What's it mean for my Tesla? Okay. And you know which sectors you're in. You know which which stocks you're in. So if you get the broad general news, hey, if it's gapped up like this, is it likely going to be because of commodities and staples, or is it probably going to be because of tech? And depending on what's going on in the markets, most of the time it's probably going to be because of tech and not your staples. And if I'm long tech, then I can check on my tech positions. Is it time to take profits? Do I think it can run up further? Things like this. Okay, so you know your position. You know it really well. It is better. Who said it? Was it Buffett? I can't remember. Put all your eggs in one basket and watch that basket very closely. All right. I know for sure Buffett said that diversification are for people who don't know any better than, right? It's a smart tool for people who don't know anything about the market. It's a terrible, terrible, terrible tool if you're educated in the market. And it is a kind of, in my opinion, okay, that's stupid. If you want to claim yourself to be a professional, it shouldn't be a tool at all unless it makes your client comfortable and they want it it makes them more comfortable with the risk. Okay. So it should be client dictated and not you dictated as a professional. Right. So I want to be concentrated. I want to be concentrated in the best stocks, especially if I have a small account. If I have the smaller my account, if I have $500, how many positions can I be in? If I have $200, how many positions can I be in at one time? 1 or $100. If I have $100, I can only be in one position. I'm going to do everything I possibly can to make sure it's the best damn position I can be in, right? I'm going to do all my research. I'm going to look for the perfect setup. I'm going to wait for the perfect timing. I'm going to look for the exact option that I want to use, the one that gives me the best reward, like the best amount of safety, but still compensates me very well. I'm going to be super, super careful with that $100 in that one position. Put all my energy, effort in. I'm not going to look at any other stock, right? If I only have $100, it's my only $100 and I have it all on the line, I'm going to be bird dogging that stock. I don't care what S&P is. Well, I might sort of care what S&P is doing, but I don't care what any other stock is doing. I'm just staring at that stock all day long, right? And just making sure I'm taking care of that one position. Okay. If you have, the smaller your account is, the more fanatical you need to be about watching your positions, because you have outsized risk. You're not the $100 million fund with only 1% or 0.5% of your money into a single position. You have, if you're putting $500 into a position, you have 10% on a $5,000. You have 10% of your account. One bad trade going to zero puts you down 10%. 5 bad trades puts you in half. You have to double your account now in order to break even, which is why this max 5 long positions and why you'll mostly want to live in here. Okay, -3 to 3, because if it all goes to crap and there's a COVID event, now you have 70%. 70%, okay? And what does it create? What does it take to recover from 70%? Let's just say, okay, 100, well, so that doesn't make sense. 90, 80, 70, 60, 50, 40, 30, 20, 10. Okay, so if I lose 10%, so I've lost 10. Okay, what percent do I need in order to get back into 100%? Okay, so basically, what times this equals 100? So 100, I need to make these percentages. Okay. 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 So if I lose 10% of my portfolio, I need to make 11% on my portfolio to break even. If I lose 20% of my portfolio, I need to make 25%. If I lose 70% or 30% of my portfolio, I need to profit by 42% of my portfolio. In options trading, okay, for options trading, this is doable. It's not super easy, but it's doable. So in your average trade alert service, what is the average win when you win? Is it 40% or is it greater or is it less? And I would venture to say that 40% is sort of a midpoint for most good and competent trade alert services on options alert services. And I'm just talking about the wins, not the win and the loss average together, just the wins. Okay, 42 is probably a good midpoint average. 66 is going to be pretty rare to have the average win be that high. Out of all my services, only one service has an average win above 66%. Okay, 100% is going to be super rare. You're not going to find any or very few where the average win is above 100% at 150% and you have a high win rate. You might have a 40% win rate with 150% average win. That is possible, but not a 60, 70, 80% win rate with 150% possible. You're not going to find any trade alert service. If you find one, please tell me. I will subscribe to it and I will learn from that person. Okay, because you're not going to find it. Okay. And then I don't know of any, I've never heard of any alert service or anyone where the average win is, well, okay, I'll take that back. Okay, but 233%, 400%, 90%, you're not going to see it. You see this type of thing inside like venture capital, where they have like a 10% hit rate or even a 1% hit rate. But when they win like 1,000%. So they go in, I have $1 billion VC fund. I put $100 million into 10 different startups. 9 of them fail, so I lose 100% right there. And then the last one turns into a $100 billion company, and I make all my money back and then some. Okay, and that's this type of situation. 30, 40, 20, 10%, okay? Or basically, if you lose 60 to 70 or 80%, okay? You're not gonna see these. You're not gonna see this 100%. You're not gonna see these. This is gonna be super rare. And so this is why you want to live in this +3 to -3 area. Because if there is some crazy event that takes out your positions, at least you're only down 30%. Okay, and it is recoverable. It is doable. It is doable within a year. Maybe if you're really good, you're doable in half a year. Okay, it's doable. This, you gotta be really good. Not every professional would be able to swing this. And even the best professionals, there's no guarantee on any given year they could do this. They might be, if you say, Kane, could you do this 7 out of 10 years? Yeah, I could do this 7 out of 10 years. If you say, Kane, can you do this every single year for the rest of your life? I'd be like, hang on a second, all right? Or not miracle worker. I can't promise that I could perform at that level every single year for the rest of my life. A lot of things are going to be not even dependent on me. They're going to be dependent on the market as well, okay? So you want to live in that 3 to -3, because if you lose, then you are going to, at least it's recoverable, easily recoverable, I should say, easily recoverable for someone who is professional, who's very competent at what they're doing, okay? If you learn the skill well enough, then this is relatively easily recoverable down to 30% of your portfolio. Okay, so we want to live right there. So forgot who asked, but do you want to go into smaller allocation size? My answer is no. Why divide your focus? You want to be expert at your positions. You want to bird dog them very carefully. And so you say, well, can I have 20 positions at 250 each? No. You're not going to track them nearly as well. And you're not going to be able to put your time and effort and attention, and more importantly, I think, your excitement into each one. So if I'm looking at a small portfolio, meaning $1 million or less, I want to be excited about every single position that I'm going into. So if I say, I love this trade, I love this setup, I love it, I love it, I love it, I can't wait to put my money into it. That's the attitude I want when I go into the trade. If I'm managing $100 million, $1 billion, of course, I'm not going to love every single one, okay? I have to get a certain amount of capital allocated, I have to put a certain amount at risk, and then I have to see what the returns are. And there's going to be a handful of them that I absolutely love, and others that I think are good, and others that I think are just okay, but I need to put that capital to work, because they're not paying me to just sit in cash, right? Although if the market warrants it, I can be in all cash and I can make the argument, this is what the market warrants. But I can't sit the entire year in all cash and say, oops, sorry, you didn't make any money, but you owe me the management fee, right? I can't do that. So if in a small portfolio, each of these positions, I want to be super excited about them. I'm gonna be like, oh my God, this looks so good, I can't wait to put my $500 in there. And I wish I had 10 times the account size so I could put $5,000 in there. And that's the attitude I want about every single one of my positions if I'm on a small account. If I have 5 longs, 5 shorts, or if I have 10 positions max in my account. Even if I was 20 positions max in my account, I would want that attitude. It's hard to find that many where you're just like, oh my God, I can't wait to put my money in this. It's hard to find 5 at a time where you would want to do that on any given day. Very, very, very difficult, okay? Without going across many systems. You'd have to, and most people can't handle that many systems also. But what a lot of you are doing is you're subscribed to a whole bunch of systems, and now you're getting a lot of signals and all of the people who are running the experts that are running those services, hopefully they're not just going, oh yeah, I'm obligated, I have to give everyone a trade. I get emails on a pretty regular basis. I gotten it in the last 2 weeks especially. Kane, please give us more trades. Kane, please give us, we need more trades to make more money. You know, please give us 5, 10, 20 trades every single week. You're only giving us like 2 or 3 or 1 sometimes. Please give us more trades. And my attitude is, why? If I won't give you a trade, I want to be like, I can't wait to give this trade to everyone. I can't wait for everyone to put their money into this. I can't wait to see the result. I can't wait to see how much money everybody makes. Right? That's the attitude that you want inside of your portfolio, especially if you have a small account. That's what you want in every single one of your positions. So hopefully all of the experts that you're subscribed to have the same attitude. And now your job is, oh my God, these 5 guys that I think are really amazing traders, I really love them. They're all giving me their like absolute best. I think we put top stock choice too mildly. Like if we go on a round table and now all of us give us our top trade ideas, I think we use that term so much that everyone just sort of gets desensitized to it. Oh, okay, let me take that trade. Now I want to be like, this is so good, I can't wait to give it to you guys. It's so good, I can't wait to put all my money behind it. And that's how I want my entire portfolio built. So hopefully you're getting, if you're subscribed to 5 different guys, you're getting 5 different alerts that all 5 guys are super excited about the one that they gave. And then now it's up to you. It's like, okay, well, which one of these 1, 2, or 3 am I super excited about? Now, in order for you to get super excited about, there's one of 2 requirements. One, you really love the system. The system was explained to you really well, and the performance shown to you in a way they're like, oh my God, this system gives great picks. And so I've been getting really great results following this trade alert service. And so I'm going to take it every time. I can't wait to get that next one, because every time, like majority of the time, it really works out really well for me. Or the person has explained the system to you so well that you can look at and evaluate every single position for yourself and go, oh, I see why he picked this one. Oh my God, he's right. I should be really excited about this. Oh my God, I can't wait to put my money into this. Okay, so a lot of people have this idea like, the more trades I make, the more money I'm going to make. Kane says that I can't trust the statistic until there's 50 or 100 trades. I can't expect to get the system results unless I have a large number of trades. And therefore, I want as many trades as possible. And then that way I can get quickly to the result, to that average result, the expected result. So when we do those expectancies, like yesterday I was doing those expectancy calculations, I said we can expect X% per trade. They were negative yesterday, but we can expect, just say 10% per every time we trade. Across 100 trades, I would make 10% on each one of those 100 trades. I'll end up making 1,000% on my single allocation. That's the expectancy calculation. So when we hear things like that, you're like, oh my God, but give me more trades, so I can get to that result faster. The problem with more trades all at once is they become highly correlated. If I gave you 10 trades on the same day and then 10 trades the next day, those 20 trades are going to be highly correlated because they were put on in very similar market conditions. So we can't rush this, okay? We want to be in the best trades at the time. I don't want to give the people who ask me for more trades, I usually just sort of ignore them because I don't know how to explain it to them in a way. Maybe I need to give them this speech where you don't want me to give you more trades. You want me to give me the trades that I just absolutely cannot wait to put my money behind it. And I can't wait to have you put your money behind it too, because I'm that excited about the trade. Those are the trades that you want in your positions, okay? Why? Because you have a limited number of slots. You have a limited number of slots. And if you want to say, I want to increase the number of slots, then you're diversifying and you're splitting your focus. And what you're also happening is you're getting hidden correlation. You don't realize that with 3 or 4, maybe 5 positions, I can avoid correlation. Anything beyond that, I'm going to get huge correlation. Somewhere on one of them, I'm going to get correlation. So if I go over here, come on. Stock fetcher. Can I go anyways? Let me visit anyways. Stock fetcher. Nope. Maybe a different browser. That's interesting. Okay. So if I go over correlation. Okay. So let's try to find 5 uncorrelated stocks. Let's see if we can even do it. Let's see how easy it is, okay? And we're going to do all of these off of 30-day correlation. Okay, so let's pick some stocks. If I say, okay, Caterpillar, NVIDIA, those supposedly should not be very correlated. Let's try to find maybe an energy stock, so CVX, maybe a healthcare stock, CVS. Okay, so now I'm in industrial, I'm in semiconductor / Mag 7 / tech. I'm in energy, I am in healthcare. What's something unrelated? Consumer, we could do we already did it industrial. We could do let's just say UEC. Is that uranium or lithium? UEC. UEC. Come on. Uranium. Okay, it's uranium. Okay. So, okay. All right, yeah. Okay, I'll replace CVS with J&J, and then I can add KB Home into there as well. Okay. So we've got 6. Okay. So let's take a look. So I want correlation with 1, 2, 3, 4, 5, 6. 3, 4, 5, 6. And I'm going to do 30-day correlation. And we're going to do CAT, NVIDIA, CVX, J&J, UEC, KB. Okay, Caterpillar, 86% correlation with the SPY, 90%, this is Caterpillar, 90% correlation with the QQQ, 63% with NVIDIA, almost no correlation with CVX, 76% with UEC, 54%. So highly correlated, I would consider 65 and up, highly correlated. So 63 comes close, but look at this, UEC, bam, correlation. CVX is done the best, is barely correlated with anything. J&J, pretty good, not really correlated with much. KB Home, We've got that UEC correlation, and then we've got obviously a lot of SPY and QQQ correlation. NVIDIA, we've got only 63 with CAT, so not too bad. And UEC, we already did, I think. We basically said with our 64 and 76. Okay, so we picked 6 that are in completely different sectors, that are pretty far apart from each other, that aren't really all that correlated. And we still had at least 2 or maybe 3 positions that were still considered high correlation. It's not easy to get rid of correlation. Imagine I try to find a 7th stock in here to say, let's find ones that are, none of them are 65 plus. It's really, really, really hard. Really hard. And so if you say, I'm going to take smaller allocations and I want to put more positions, then all you're doing is saying, I'm going to increase the correlation and I'm not really diversified. And if I have high correlation, I might as well concentrate onto the one that I'm more excited about. Okay. So put your money behind the one that has the better probability, the better opportunity of actually making you money. Why? Because we have a small portfolio. If you had $10 million, that might be different. That's probably the cutoff, okay? $10 million, it would be the minimum, the bare minimum where I would consider more. So even on $1 million or $2 million account, I would still be doing a 10 portfolio, 5 long, 5 short max, okay? I've gone over time and I didn't get anywhere near where I wanted to explain to you guys on building the portfolio, but I think we have a really strong foundation, and hopefully you guys are getting the message. Let's see what you guys are saying. I cut down from 20 to 10. Good for you. Good. Drunken Miller? Maybe Drunken Miller. The Jenner and me would take $200 to a roulette table. Nice. Carnegie said, Peter, I'm not sure, maybe we're saying about, were we talking about diversification? I don't know, maybe. I doubt it was Carnegie. Carnegie was very early. With a small account, which service of yours would you start with? I would start with morning payout plan. I've lost 60% of my profiles. It's been over 2 years still and not back where I was. Learned a lot from it. Okay, great. Good, Chester, good. Thank you. If you have a lot of small positions, is it a distribution risk? Yeah, if you have a lot of small, that's kind of what we were saying here. You actually have a bunch of correlation and you'll have distribution risk, yeah. Okay, all right. Thanks for making it real. You're welcome, Bernadette. Dean, great info. Good, thank you, Dean. Great training, thank you. You're so good at explaining. Oh, thank you, Kay. Thank you very much. Okay, so we'll end it here. We'll continue this tomorrow where we'll go, okay, small portfolio, here's small being under 10 million, okay. Here's how we start to build it up and how we get that steady equity curve, and that steady equity curve will allow you to take regular withdrawals, okay. All right, guys, hope you guys have had a great time today and are learning a lot. Again, if it's been helpful to you, I appreciate the thumbs up on the videos. And I hope you have a wonderful rest of your night, and I'll see you guys tomorrow. Okay. Bye, everyone.